have the ability to put a number to the issue. Multi-year forecasting, we talked about it earlier. Once you kind of get this dynamic functionality and work out your foreign tax credits so that you can see the full impact of all these provisions, you need to run it out a few years to make sure, when the rates change for FDII or GILTI, when the rates change for the BEAT, are you back in a situation that you don't want to be, or if the business turns, and it really depends on how your business does their long range planning. Is it a 5-year strat plan? Is it is a rolling plan? However FP&A is going through that process, you're going to want to get on board with that and start taking those guys to lunch, those gals to lunch. Make sure you understand what numbers they're running so that you can either put in best case, worst case as your underlying financial inputs, or just otherwise make sure that you've got the latest and greatest numbers. Because then at that point, scenario planning under number 4, this is really where you're going to do that what if planning. And again, it may be all around technical positions as it relates to 861. That if you're in that excess GILTI credit position, as Nick mentioned, every dollar of expense being apportioned against the GILTI basket will cost you 21 cents on the dollar. So that's really the solve for in that case. Or maybe you're looking, on a BEAT side, what if we change the supply chain? What if we recharacterize some of the payments or qualify them for a service cost method? All these things need to be compared against that base case in order to understand what the impact is to your overall tax profile. The last two, transition tax. If you're a 1231, you want to take into account your 1130 companies. That income, that transition tax, is going to be a 2018 item. That's going to impact some of your BEAT 163J calcs, things of that nature. Just making sure that you've got it all rolled together, that you can kind of walk it from 16 through 17 as the transition year into 18 into the post tax reform, and you've got a consistent story in terms of the methodologies and approaches. And then the audit history, this may be more on our side in terms of how we roll numbers from version to version within our models. But I think the key here for anybody doing modeling in-house is make sure that you understand what those assumptions are. Make sure that you leave yourself a breadcrumb trail of some sort to understand, once you've created that base case, how are you testing that base case with these different scenarios so that you're able to create that spectrum of best case, worst case, and able to really refine that message to communicate to management about what is driving a good answer or a bad answer so they can make decisions about what to do with it. On the next one, we talk about a process flow, and this is something that we use internally, talk about with our clients about how we prepare for those planning meetings. And it's really about getting, in our case, we've got the model built, but how do we prep that model? We're using XML data from a recent tax return. We're scrubbing those numbers to make sure that the ownership percentages and all the entities are still correct. And then we're going out. Step 2 is really where so much time is spent getting those forecasts of both TI from a domestic standpoint as well as the foreign subsidiaries. A lot of times that stuff isn't being forecasted on a legal entity basis, so it's really going to be a conversation at some point with the business, usually on a regional basis, but sometimes, for the larger entities, they've got finance teams or even tax professionals in the local jurisdictions that you can talk to, getting that latest and greatest information. We have a series of dashboards where we kind of pull together the impacts of, say, GILTI, FDII, BEAT, 163J, reviewing those to make sure that you're getting the intended results that you expected, and if you're not, you're able to dig into it to understand why you're getting a different answer. And then the FTC. I think Nick did a great job kind of running you through what the impacts are and how the expense apportionment will impact that overall foreign tax credit profile in the different baskets. But it's going through and doing that income sourcing and really spending the time to understand what your expense apportionment, that allocation or apportionment of interest expense, R&D, headquarters. This is all going to impact not only your foreign tax credit profile, but it's going to come back around and impact the profitability and the margins for your FDII calculations, which is ultimately going to drive a benefit within your tax return. At that point, we're at the place where we can say that we've got a good solid base case. At which point, we start talking about, all right, how is this impacting the operations of our structure, and what changes might we need to make as a result of that. So I think at that point we're going to go back over and talk about some of the benefits.
Okay, let's before we jump over to the to actually talking about the flex model, let's do our third polling question and take a quick look at that and go ahead and answer it. The answers to the second question are really only a small percentage of people, 10%, are actually have decided to restructure their operating structure in Allied. Most people are roughly 60% are either still studying the law or actually thinking about changes. So we're still, I guess, in some ways in the early stages of people's application or implementation of the new law. So with that, Nick, why don't you go ahead and talk specifically about the flex model?
Sure. So if we flip into the flex section and we're on the provisions that it covers, we've designed the tool, and this is consistent with the Plus, just for folks on the phone. We created a couple of different products within our suite of ITS engine tools for really just user preference and to diversify our product portfolio. The tools are laid out a little bit differently and accomplish in principle a lot of the same things, but certain people like the way certain things operate or are shown or illustrated. So we've got the two tools for those reasons, just broadening our portfolio. In the Flex tool as well as the Plus, the provisions included are the GILTI calculation, the FDII calculation, and GILTI deductions. The interest expense limitations for both U.S. level, CFC level interest expense apportionment under 861, NOL carry forwards, FTC limits, recaptures under 904F and G, FTC carry forwards along the lines of your separate baskets that carry, that is general passive branch. GILTI doesn't have FTC carry forwards. And then, of course, BEAT. So all of these items are necessary and required in a model, and what's important, I think, in terms of how we go forward and how we plan, if you don't have a 100% dynamic model and or it can't manage these NOL, FTC limit and recapture rules, as well as the FTC carry forward, and that goes all the way down from the tracking mechanisms looking out, to Mike's point, multiple years, then you're really going to have a hard time planning and or forecasting the impact of planning on your either book or cash tax rates. And the reason for that is you got to be able to track all this stuff, and it's got to be dynamic. If it's not dynamic, you will not be able to. You will be spending more time making the calculations and muscling some of these calculations rather than spending time in where you have more value add. That is analyzing how all of these interrelated rules are playing against each other and really understanding the mechanics of what's driving your results. And so we really tried to build our tools along those lines. That is dynamic, multi-year, having the ability to track along NOLs, foreign tax credits, and that is one of the biggest pieces of this whole equation, because foreign tax credits, everybody's going to have to deal with them now in this world to manage your tax down. And so when building the tool, we built the tools out on really, in terms of the Flex, on the usability of it. We really focused on that rather than at first the technical aspects. Everybody will get the technical aspects right. I think it's important in any tool that your company has, whether it be one of the ITS engine or something else, that the tool is user friendly and there's features in a user-friendly tool that you really need to make sure they are there, because you got to have them to understand what's going on. And so from our perspective, when we were building Flex, it needed to be lightweight, it needed to be intuitive, it needed to be user-friendly. I don't care whether the tool can get it technically right. If it's too hard to understand or manage, like a VCR button, a remote with too many buttons on it, you'll never use the VCR. You'll never use the tool in this case if it's too complex and is not intuitive. So we made sure we made ours user friendly, and I think it's important you have that in a tool go forward, given some of the reasons we discussed around the interrelated provisions. It's got to be multi-year, multi-scenario. You got to be able to run scenario comparisons. You got to be able to do this fast. That goes down to the automation, and it goes around how you structure and lay out the design of the tool. It's got to be transparent and auditable. That's a very big point. If it's a black box or you can't see things, that is, you're building your calculations out with formulas overlapped on formulas, and there's no real clear storyboard that shows you how the calculations build up and ping pong off of each other, then it's going to be very difficult for you to diagnose what your issue is, with a tool that doesn't do that. And then you got to be able to flex and scale it. You're going to have a lot of things thrown at you in this new world where we've lost deferral, and you've got to calculate all the overlapping provisions against all the foreign income coming back, and how you work your tax down, and how it ping-pongs around against these provisions. You got to be able to have a tool that can flex and scale. That's why we've named our tool the ITS Flex, because it can go one to many and really comes out of the box and can overlap against a lot of different taxpayers. So just to kind of talk high level about how the tool kind of works from a one-to-many perspective. I'll get into that, and then I'll also kind of show you what we do around planning. On the slide after the provisions we cover in the tool, we've shown here a quick snapshot, and I think it's important when you build your tools that you have a way to communicate to your stakeholders. So there's got to be some set of graphs and charts that are coming out. This graph or chart here shows you how you can, one, spot an issue. In this example, we've got a UK OPCO. The chart, the diagnostic that's coming out of the tool is telling you UK OPCO has a tested loss for guilty purposes, but it had Q-buy. You're losing that Q-buy. You're losing that Q-buy for purposes of